You've definitely heard of Michael Burry, the guy who predicted the 2008 financial crisis. This guy's a stock market oracle, as he foresees financial storms before they hit. Well, he's in the news again, and it's not all sunshine and rainbows. Let's find out why. Here's a sneak peek into who Michael Burry is. Michael Burry was the man who foresaw the housing market crash of 2008 and made a fortune from it. However, he didn't start out as a Wall Street wizard. Nope, his story began in San Jose, California, where he was born in 1971. As a child, he showed an early fascination with numbers and finance, a foreshadowing of what was to come. Burry's journey into the world of investing kicked off when he studied economics and pre-med at UCLA and Vanderbilt, respectively. Yes, you heard that right, pre-med. But fate had other plans. He discovered his true calling during a medical residency, realizing that finance and investing was where his passion really was. In the early 2000s, Burry founded Scion Capital, a one-man hedge fund, where he made a gutsy bet against the subprime mortgage market. Maybe you've seen the Hollywood portrayal of this in The Big Short. But this was no movie script. It was what actually unfolded in real life. Michael Burry was seeing what others didn't, or maybe wouldn't. He saw the housing bubble inflating, and he knew it would burst. You know, back then the subprime mortgage market was a ticking time bomb within the housing industry. Risky mortgages were dished out like candy on Halloween, all bundled up and sold to unsuspecting investors. These mortgages were the shaky foundation of a massive housing bubble, with Burry being one of the few who saw the cracks forming. Despite facing skepticism and criticism from many, he stood his ground, doing meticulous research and crunching numbers. His conviction paid off. He bet against the stability of this market, sensing its impending collapse, a move that defied conventional wisdom. When the bubble burst in 2008, it shook the financial world to its core, validating Burry's foresight and earning him a place in the annals of financial history. When the housing market imploded, he made a fortune for his investors and himself. Not only did he have nerves of steel, he had an intellect to match. The book that was later adapted into a movie, The Big Short, is about Burry's life. If you haven't seen it, I highly recommend it.
Michael, how are you?
I found something really interesting.
The whole housing market is propped up on these bad loans. They will fail.
The housing market is rock solid.
It's a time bomb.
So Mike Burry, who gets his hair cut at Supercuts and doesn't wear shoes, knows more than Alan Greenspan.
Dr. Mike Burry, yes he does.
Burry's story doesn't end there. He continued making bold prediction and investment moves. He invested in water, foreseeing a future where water scarcity would become a significant issue. He's also been vocal about his concerns regarding the current stock market situation and potential bubbles in certain sectors. Some of the reputable companies he's been associated with include notable names like GameStop. Yes, that GameStop, the company that had a meteoric rise largely due to retail investors rallying behind it. Burry was one of the early investors to recognize the potential for a short squeeze in GameStop stock. Michael Burry's journey from a childhood fascination with numbers to becoming a prophetic investor teaches us a valuable lesson. Perseverance, keen observation, and the courage to go against the tide can make all the difference. So when he sounds an alarm, it's worth paying attention. After all, this man has a track record of being ahead of the curve, even when the majority dismiss his insights. Another market storm is brewing. Burry echoes using history. Well, he's back in the spotlight. Michael Burry, dropping some hints that set off alarms in the financial world. His cryptic tweets are suggesting a potential market crash in 2023, and the similarities he's drawing with the pre-2008 period are pretty eye-opening. Burry's ringing the same bells he did before the 2008 crisis. He's pointing at three major concerns: excessive speculation, risky lending, and overvalued assets. These were the red flags back then. And guess what? They're waving in the wind today, too. Take the housing market, for example. It's bustling, but eerily resembling the pre-housing crisis era, with prices inflated to the max and subprime mortgages ready to explode. Then, there's the wild frenzy around meme stocks and cryptocurrencies, and Burry's not thrilled about it. He's seen this kind of speculative bubble before, and it didn't end well. It's like history's rhyming with risky loans and inflated assets again. He's also warning about banks playing a dangerous game, juggling high leverage with minimal capital, just like they did before the 2008 meltdown. And let's talk about government policies. Burry's pointing out the striking similarities to the pre-2008 era, when good intentions had unintended consequences. Today's monetary policies, meant to rescue the economy, might inadvertently be setting up for a future disaster. It's a delicate balance, and we've got to be cautious. Burry's sounding the sirens loud and clear. The financial landscape is showing some ominous signs. His insights paint a picture of an approaching storm. It's a call to action for investors, financial institutions, and policymakers. We've got to be proactive, make smart moves, and avert a potential catastrophe. In the intricate world of the stock market, history's the best teacher. Burry's tweets are like signposts, urging us all to rethink our strategies. If we can navigate this potential crisis collectively, it might just mark a turning point. We could steer away from the edge and chart a course towards stability and sustained growth. Let's keep our eyes peeled, learn from the past, and sail through these choppy financial waters. Still watching? Don't miss out on the most important bit about the housing crisis right at the end of this video. Watch out for inflation. Michael Burry's tweeting about inflation, the economy, and how rising interest rates could throw a monkey wrench into our everyday lives and the stock market, even pointing to a giant like Amazon. So first things first, what's inflation? Inflation means the prices of stuff we buy every day, from a cup of coffee to a pair of shoes, are going up. Imagine your favorite snacks costing more each time you hit the store. That's not a fun surprise. Now, Michael Burry, who famously predicted the 2008 financial crisis, is ringing the alarm bells about inflation. He's warning that this inflation hike might not just squeeze our pockets, it could send shockwaves through the stock market. How? Well, let's break it down. When inflation kicks in, interest rates often follow suit. As the economy heats up, the bigwigs sometimes decide to hike up interest rates. Sure, it's meant to keep things in check, but it's a double-edged sword. Higher interest rates mean companies might have to pay more to borrow money. For big players like Amazon, that could translate to higher costs for expansion, innovation, and just keeping the wheels turning smoothly. And here's where it gets interesting. If companies face higher costs, they might pass them on to us, the consumers. That means the stuff we buy from companies like Amazon might also get more expensive. Now, if prices surge too much, consumers might tighten their belts, and that could hit companies' bottom lines. And guess what? That can reflect in their stock prices. Imagine Amazon's stock taking a bit of a hit. It's a ripple effect. Burry even pointed out Amazon specifically in one of his tweets, emphasizing the potential impact on its stock. It's like a wake-up call for investors to stay sharp and watch how this story unfolds in the stock market. The long and short of this is, the economy is like this giant puzzle, and every piece, like inflation and interest rates, affects another. We've got to keep an eye on it, adapt our investment strategies, and brace ourselves for the ride. We must stay informed, make smart moves, and keep our fingers crossed for a stable market ahead. Burry invests in farmland. What can we learn? Burry's bet on farmland underscores his belief in the future value of agricultural land and water resources. This isn't a typical investment. It's a strategic move. Reasons for investment. Future value of farmland. Burry sees potential in farmland due to the increasing global demand for food. With a growing population, the need for agricultural produce will surge, making farmland a valuable asset. Water resources. Access to water is critical for agriculture. Burry's investment also accounts for the increasing scarcity of water globally, making farmland with good water access more valuable. Statistics. Global population is projected to reach 9.7 billion by 2050. Water scarcity affects approximately 40% of the global population. Risks and rewards. Investing in farmland can potentially provide long-term returns as food demand rises, especially in developing regions. Farmland tends to be a tangible, appreciating asset. Risks. Farmland investments aren't without risks. They can be affected by changing weather patterns, regulatory changes, and shifts in consumer preferences. Additionally, managing and operating a farmland investment comes with its own set of challenges. Lessons for investors. Diversification. Burry's move emphasizes the importance of diversifying investment portfolios to include alternative assets like farmland. Long-term vision. Recognizing and investing in future trends is crucial. Understanding the implications of global shifts, like population growth and resource scarcity, can inform smart investment decisions. This investment move by Michael Burry urges us to pay attention to the changing dynamics of our world and make informed decisions to secure our financial future. What is Burry's hard truth? Michael Burry's bold investment in farmland and water resources holds a profound message. Our world is changing rapidly, and key resources like food and water are becoming more scarce. Burry's strategic move serves as a wake-up call, urging us to prepare for these imminent challenges of the stock market by seeking viable alternatives. To navigate these uncertain times, we must diversify wisely, invest with a long-term vision, and adapt to the evolving landscape. Ignoring this urgent message could come at a great cost. It's time to take action, ready ourselves, and secure our future amidst the storm on the horizon. I'll see you in my next video. Cheers!